The end of the play. First Citizens Bank takes over Silicon Valley Bank. But the risk of a U.S. recession is inevitable. First Citizens Bank shares will acquire all of Silicon Valley Bank's deposits and loans, according to U.S. regulators, on March 26 local time. The U.S. Federal Deposit Insurance Corporation (FDIC) issued a statement stating that it signed a contract with First Citizens Bank, located in Raleigh, North Carolina, on all deposits and loans of Silicon Valley Bridge Bank. Silicon Valley Bridge Bank signed the assignment and assumption agreement. The statement pointed out that the 17 former branches of the Silicon Valley Bridge Bank will open as First Citizens Bank on March 27 local time. The FDIC created the Silicon Valley Bridge Bank on March 13 after it was named receiver of the former Silicon Valley Bank by the California Department of Financial Protection and Innovation. Jesse Park, an American economist at Bank of America Securities, told China Business News. Although policymakers use temporary tools to maintain financial stability in response to urgent pressure on some regional banks, the unresolved question is whether and to what extent the situation will lead to excessive tightening of bank lending standards. While large companies have the flexibility to access financing through the banking system and capital markets, small businesses and households are more reliant on bank credit. Further tightening of bank lending standards there are downside risks to the U.S. economic outlook. The end of the Silicon Valley Bank collapse. The statement shows that as of March 10, the total assets of the Silicon Valley Bridge Bank were approximately $167 billion, and the total deposits were approximately $119 billion. The deal includes the purchase of approximately $72 billion in assets of the Silicon Valley Bridge Bank at a discounted price of $16.5 billion. About $90 billion in securities and other assets will remain in receivership at the disposal of the FDIC. In addition, the FDIC received equity appreciation rights in the common stock of First Citizens Bank AG, with a potential value of $500 million. The FDIC and First Citizens reached a loss-sharing deal on a commercial loan it purchased from a former Silicon Valley Bridge Bank. Under the agreement, the FDIC and First Citizens Bank, as recipients, will share in losses and potential recoveries on the loans covered by the agreement. The loss-sharing deal is expected to maximize asset recovery by keeping assets in the private sector. The deal is also expected to minimize disruption to loan customers. In addition, First Citizens Bank will assume all qualifying financial contracts associated with the loan. The FDIC estimated that the failure of Silicon Valley Bank would cost its deposit insurance fund DIF approximately $20 billion. The exact cost will be determined when the FDIC terminates receivership. So far, as the largest bank failure since 2008, the failure of Silicon Valley Bank has come to an end, but the banking crisis triggered by it is still brewing, and it has aggravated people's concerns about the U.S. economic recession. The U.S. economy may be in a moderate recession. Park also told China Business News that the bank still believes that the U.S. will experience a moderate economic recession later this year. The disagreement over the economic outlook within the Federal Reserve is also growing. Minneapolis Fed President Neil Kashkari said, recent stress in the banking sector and the possibility of a subsequent credit crunch has brought the U.S. economy closer to recession. It's definitely getting us closer to a recession. Kashkari said what's not clear to us is the extent to which these banking stresses will lead to a broad credit crunch. That credit crunch will lead to economic slowing down. That's something we're monitoring very, very closely. What's more, it is believed that the collapse of the Silicon Valley Bank will trigger a financial crisis. ANZ Chief Executive CEO Shane Elliott said the latest turmoil in the global banking system had the potential to trigger a financial crisis. Although it was too early to predict what could trigger a 2008-style crisis that said, "The turmoil is clearly not over," I don't think it's easy to say, "Well, it's over. The Silicon Valley Bank and Credit Suisse thing is over, and life will go back to normal." These things tend to take a long time. It will take a while to digest, he said.